Hello everyone, and welcome back to another episode of Simply Wall Street's Market Insights. My name is Michael, and this week we are talking about the most successful ETF launches of all time. That's right, the Bitcoin ETFs. We're also going to talk about the regulatory green light in the United States, institutional buy-in, the insane pace of adoption, and a risk that most investors are sleeping on. If you'd like to read the full piece, you can find the link in the description. And just a reminder, if you're not here for the market recap, feel free to skip ahead using the chapters below. Now, with that being said, here's what moved markets this week. First up, Intel might be getting a helping hand from Uncle Sam. According to Bloomberg, the Trump administration is exploring a direct stake in Intel. The chipmaker has faced setbacks on its massive Ohio project, and this move could stabilize both Intel and the United States chip agenda. If it goes through, it may set a precedent for deeper state involvement in strategic sectors. Next up, wholesale inflation roared back. July's producer price index rose 0.9%, which is the biggest jump since mid-2022, with core PPI driven by services costs. This surprised markets and has traders rethinking the Fed's interest rate path. The odds of a few rate cuts this year is now looking less likely. Next up, Berkshire Hathaway is bargain hunting in healthcare. Buffett's firm just plowed $1.6 billion into United Health, a stock that's down 50% this year and dealing with legal clouds, executive exits, and uncertain earnings. They're also trimming big tech positions and doubling down on industrials and home builders. I suppose we need to remember Buffett's mantra, buy when others are fearful. Next up, Japan's economy expanded more than expected in the second quarter. Q2 GDP beat estimates thanks to a reprieve from Liberation Day tariffs. But with a 15% tariff now hitting all exports to the US, especially autos, pressure is building for Japanese manufacturers. And lastly, oil markets are staring down a record oversupply. The International Energy Agency now expects global oil supply to rise by 2.5 million barrels per day next year, which is far outpacing demand. Brent crude oil is forecasted to hit $50 per barrel in 2026. Good news at the pump, but not great for upstream producers and oil services companies. Diversified oil and gas producers are less exposed, while refiners can benefit from lower input costs. Now let's get into the main piece. Last December, we mentioned how institutional adoption of Bitcoin could reshape the narrative. Fast forward to now, and it seems it's happening. Endowments, corporations, even parts of the US government are allocating capital to Bitcoin or making plans to. So today we're unpacking what's changed in regulation, what's driving adoption, and the real risk that's flying under the radar. First, let's talk about regulation, a swift and material shift. The US has made some surprisingly pro-Bitcoin moves in 2025. Here are some of the biggest ones. Firstly, banks can now custody digital assets after the SEC rolled back SARB 121, removing the need for one-to-one cash reserves. That was one of the major hurdles for large institutions to custody Bitcoin for their customers. While many haven't done it yet, it does take a while for banks to move. Then there's two executive orders that signal the clearest pro-Bitcoin stance we've seen yet, banning a US central bank digital currency and formalizing Bitcoin as part of the strategic reserve. And then there was Crypto Week, which was huge. The Clarity, Genius, and Anti-CBDC Acts were passed by the House. The Genius Act is now law, while others await Senate action. These moves have essentially flipped the regulatory tone from proceed with caution to come on in, the water's fine. And investors appear to be listening. So let's talk about what that looks like in the real world. According to Bloomberg's ETF analyst Eric Balchunas, BlackRock's IBIT reached $80 billion in assets under management in just 374 days by July 11th. That is 5 times faster than the next fastest ETF to hit that same threshold. And by mid-August, just a couple of days ago, it hit $91 billion in assets under management. Eric was also a guest on OnRamp's podcast recently, where he shared some stats that really drive home how impressive this ETF launch has been. Firstly, IBIT is the youngest among the biggest ETFs. While it's now the 20th largest ETF in the US by assets under management, the next youngest ETF in that top 20 list is 12.5 years old. Both IEFA and IEMG launched in October of 2012. As Eric puts it, it's like a toddler hanging out with teenagers. Secondly, it's BlackRock's most profitable ETF. At $52 billion in assets under management a few months ago, charging a 0.25% management fee, it was already more profitable than BlackRock's flagship S&P 500 ETF, IVV, bringing in roughly $187 million in revenue. But now that it's hit $90 billion, it's BlackRock's most profitable ETF across all 1,100 funds it manages globally. Third, Bitcoin ETFs are nearly as big as gold ETFs. Across all 11 US-listed Bitcoin ETFs, assets under management now sit at $154 billion, just shy of the $179 billion in gold ETFs. Considering gold ETFs have been around for 2 decades, Bitcoin's catching up fast. And lastly, over 1,600 institutions already hold these ETFs. These are institutional investors who file 13F disclosures, meaning they manage over $100 million in assets. For comparison, he said most ETFs launched in January 2024 have just 10 to 20 institutional filers. All of this is to say 2 things. Firstly, Bitcoin ETFs have massively improved access and legitimacy. They provide simplicity, liquidity, and institutional-grade custody without the friction of private wallets or cold storage. Secondly, the sheer speed of adoption confirms that institutions are no longer sitting on the sidelines. As Eric pointed out, these players usually move slowly, but 1,600 holders in 18 months, that is a big signal. Now, here's the caveat. There is custody concentration risk, which is a hidden fragility. Coinbase Custody holds about 81% of all Bitcoin ETF assets. It services 8 of the 11 US ETFs, including the giant IBIT. The rest go their own way. Fidelity uses Fidelity Digital Assets. VanEck works with Gemini, and ARK21 Shares Bitcoin ETF uses BitGo. The issue is that when one custodian holds that much of the market's Bitcoin, you've got a massive single point of failure. Now, if Coinbase were hit by a cyber attack, legal freeze, or technical failure, multiple ETFs could be disrupted, meaning redemptions delayed and portfolios frozen. And switching custodians isn't fast. It would involve audits, new compliance checks, and wallet infrastructure. The good news is, this isn't their first rodeo. Custodians have implemented systems to reduce the risk as much as possible. They have segregated trust accounts to protect client assets, they use cold storage, they have system and organizational controls, and they use multi-party approval flows. There also is oversight from regulators like the New York Department of Financial Services. So yes, it's a non-zero risk, but it is being actively managed. So what's the insight here? Bitcoin is becoming gold 2.0. More and more investors are treating Bitcoin as a strategic asset, like gold. Take the Harvard Endowment, for example. They've recently disclosed a position in both IBIT and SPDR Gold Trust, with their Bitcoin exposure sized at 0.2%, which interestingly matches Bitcoin's market share of global investable assets. It's a market-neutral allocation and a strong signal of how seriously institutions are taking it. If you're thinking about doing the same, there's a few things to keep in mind. Consider spreading your exposure across different custodians. ETFs like IBIT, FBTC, and HODL each use separate custody providers. And secondly, keep your position sizing in check. If the bulls are right, a 1 to 3% exposure is enough to benefit if Bitcoin keeps rising. If the bulls are wrong, that kind of exposure is survivable if it doesn't. And that's where we'll wrap up this week's Market Insights. Next week, we'll be diving into Bitcoin treasury companies, what they are, why they're stacking sats, and how to evaluate their strategies as investors. If you'd like to read the full article on this week's topic, again, the link is in the description. And as always, if you've got feedback or suggestions, we would love to hear from you. And with that being said, we'll be back next week with more Market Insights. Until then, invest well.